Something just changed inside one of the world's largest banks that matters far more than it first appears. Bank of America isn't simply talking about blockchain anymore. It's building digital asset infrastructure at a time when the financial industry is racing to modernize settlement, collateral, and asset ownership. That shift could have long-term implications for how central bank and capitals move across global markets. In this video, we'll examine what Bank of America's latest move actually means, why institutions are investing in tokenization and AI, how it connects to real-world assets, and why many investors believe this is part of a much larger transformation taking place beneath the surface of today's financial system. Bank of America recently appointed Sal Theon to lead and scale its global digital asset platform. On the surface, that sounds like a routine executive announcement. But when you look at the responsibilities attached to the role, a much bigger picture begins to emerge. This position isn't focused on launching another cryptocurrency product. It includes blockchain, infrastructure, tokenization, digital collateral, stablecoins, and artificial intelligence integration. Technologies that many of the world's largest financial institutions are now investing in simultaneously. Now, here's where it gets interesting. Bank of America isn't alone. BlackRock, JP Morgan, Franklin Templeton, MasterCard, and other major financial organizations are all exploring how blockchain can improve the movement, ownership, and settlement of financial assets. The question is no longer whether institutions are paying attention to this technology. The question is how they intend to integrate it into the future of global finance. When Bank of America announced Sal Theon would oversee and expand its global digital asset business, most mainstream media barely covered the story. There were no flashing headlines declaring the beginning of a financial revolution. Markets barely reacted. Crypto prices hardly moved. But institutional investors often pay attention to signals that retail markets ignore. Banks do not create executive positions involving blockchain infrastructure unless they believe the opportunity could become strategically important. Developing institutional blockchain systems is expensive. It requires engineers, compliance specialists, legal teams, cybersecurity experts, artificial intelligence researchers, risk managers, regulatory coordination. These are long-term investment measures over many years, not quarterly earnings. That alone tells us something important. Bank of America appears to believe digital assets are evolving beyond speculation. Instead, they're becoming financial infrastructure. Now, here's where it gets interesting. Theon's responsibilities reportedly extend well beyond cryptocurrency itself. The role includes developing tokenized financial assets, digital collateral, stablecoin initiatives, blockchain infrastructure, artificial intelligence integration, institutional settlement systems, and scalable financial architecture capable of supporting tomorrow's capital markets. Notice something's missing? The conversation isn't centered on Bitcoin's next price target or whether Ethereum could outperform next year. Instead, the discussion has shifted towards how traditional finance itself might evolve. There is a completely different conversation. Instead of asking whether blockchain survives, major banks now appear to be asking how they can build businesses around it. That distinction matters because infrastructure generally creates far more lasting value than speculation alone. Prices reacting, systems evolving. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in this market. The Bank of America is far from alone. In fact, one of the biggest misconceptions in today's crypto market is that institutional adoption hasn't arrived yet. The reality is much more nuanced. Institutions aren't waiting, they're building. BlackRock has expanded into tokenized investment products. JP Morgan has spent years developing blockchain-based settlement technology for institutional clients. Franklin Templeton launched tokenized money market funds. MasterCard continues building digital asset connectivity for financial institutions. DTCC, the organization responsible for processing quadrillions of dollars in security transactions, has been actively researching blockchain infrastructure for future settlement systems. Suddenly, a pattern begins to emerge. These firms compete fiercely against one another. They rarely agree on strategy, yet many of them are independently investing in remarkably similar technologies: blockchain, tokenization, digital settlement, artificial intelligence, programmable assets. That should immediately capture investors' attention. Competition often reveals where industries believe the future is heading. If every major automaker suddenly begins investing heavily in electric vehicles, investors naturally conclude that something important is changing. The sample and the same principle applies here. The world's largest financial institutions appear to believe tokenization represents one of the next major evolutions in finance. The timing remains uncertain. The winners remain uncertain, but the direction appears increasingly difficult to ignore. Short-term noise, long-term structure. The phrase real-world asset tokenization can sound incredibly technical. In reality, it's based on a surprisingly simple idea. Let's imagine a commercial office building worth $1 billion. Traditional ownership is documented through extensive legal paperwork. Buying or selling interests in that property requires lawyers, banks, escrow services, title companies, accountants, regulators, and significant administrative costs. The process works, but it's slow, expensive, and often inefficient. Now imagine representing ownership of that same building digitally on a blockchain. Instead of relying exclusively on paper-based ownership records, investors hold blockchain-based digital tokens representing legal recognized ownership interests. Those ownership interests become programmable, transferable, divisible, transparent, available 24 hours a day. Instead of selling an entire billion-dollar building, ownership could potentially be divided into thousands or even millions of fractional pieces. This dramatically expands accessibility. Someone no longer needs hundreds of millions of dollars to gain exposure. They may only need a smaller investment. Now expand that idea far beyond real estate, government bonds, corporate bonds, treasury securities, private credit, gold, silver, oil inventories, infrastructure projects, carbon credits, private equity, stocks, art collections, intellectual property. Almost any asset capable of demonstrating ownership could theoretically be represented digitally. That is why institutions have become so interested. Tokenization isn't simply about cryptocurrency. It's about making traditional financial assets more efficient. Imagine settlement occurring in minutes instead of several days. Imagine collateral moving instantly across global markets. Imagine fewer intermediaries, lower operational costs, greater transparency, and improved liquidity. These efficiencies could save financial institutions enormous amounts of money over time. Banks recognize that. Asset managers recognize that. Governments increasingly recognize that, which explains why research spending continues accelerating. To understand why this matters, it helps to look back. One of the most transformative innovations in financial history was a new currency. It wasn't a central bank. It wasn't even a stock exchange. It was accounting. During the Renaissance, trade across Europe expanded rapidly. Merchants suddenly managed increasingly complex businesses, stretching across multiple cities and countries. The old method of keeping financial records simply weren't good enough. Then came the widespread adoption of double-entry bookkeeping. For the first time, every financial transaction created balanced records, assets, liabilities, income, expenses. Everything became more transparent. Errors became easier to detect. Fraud became more difficult to hide. Banks gained confidence. Investors gained confidence. International commerce accelerated, ladies and gentlemen. The system itself became more trustworthy. Interesting. Ordinary people hardly noticed. There were no celebrations, no newspaper headlines declaring that bookkeeping had changed civilization. Yet historians now recognize double entry accounting as one of the most important financial innovations ever developed. Blockchain could represent a similar evolution, not because it replaces finance, but because it upgrades the record-keeping system underneath it. This is what many investors miss, unfortunately. Infrastructure rarely attracts widespread excitement. People become excited about applications, not foundations. Yet history repeatedly shows that strong foundations create lasting economic transformations. Now let's discuss the area that many institutional analysts consider even more important than tokenized stocks or real estate: digital collateral. Collateral is the backbone of modern finance. Every day, financial institutions pledge assets to secure loans, derivatives, repo agreements, clearing obligations, countless other financial transactions. Without collateral, the modern financial system simply cannot function. The numbers involved are enormous. Global derivative markets are frequently measured in the hundreds of trillions, and by some broader estimates, into the quadrillions of dollars in notional value. Not all of that represents money changing hands, but it highlights the massive scale of markets that rely on collateral and settlement infrastructure. Today, moving collateral can still involve operational delays, fragmented systems, reconciliation processes, and multiple intermediaries. Imagine instead if eligible collateral existed as programmable digital assets. Ownership transfers could occur almost instantly. Verification becomes easier. Settlement becomes faster. Counterparty risk may decline. Capital trapped during settlement periods could potentially be deployed more efficiently. For large institutions, even small efficiency gains can translate into billions of dollars over time. Now, this is where blockchain becomes much more than a cryptocurrency discussion, ladies and gentlemen. It becomes an infrastructure development discussion. Banks aren't simply asking how to trade digital assets now. They're asking how digital technology can modernize the movement of value itself. And if tokenized collateral becomes a meaningful part of global finance over the next decade, the blockchain networks capable of supporting secure, scalable, and compliant financial infrastructure could receive significantly more institutional attention. Exactly which networks ultimately emerge as leaders remains uncertain. Competition is fierce. Technology continues to evolve. Regulation is still developing. But one thing appears increasingly clear. The conversation has moved far beyond speculative trading. Institutions are now thinking about rebuilding the operation and operating system of finance itself. One of the most overlooked aspects of Bank of America's strategy isn't blockchain alone. It's blockchain combined with artificial intelligence. For years, these technologies were discussed separately. Artificial intelligence wasn't viewed as the future of productivity. Blockchain was viewed as the future of digital ownership. Today, those conversations are beginning to merge. Financial institutions generate enormous amounts of data every second, every payment, every trade, every loan, every collateral movement, every compliance check. Managing that information efficiently has become one of the most banking greatest challenges. Artificial intelligence excels at identifying patterns within massive data sets. It can help detect fraud, improve risk management, monitor suspicious transactions, optimize liquidity, assist compliance teams, and automate many repetitive operational tasks. Now imagine combining those capabilities with tokenized financial assets. Instead of waiting for reports generated hours later, institutions could analyze transactions almost immediately. Instead of manually reconciling records across multiple systems, digital assets recorded on blockchain could provide a more synchronized source of truth, while AI helps interpret that data. See, for a global bank, that could translate into lower costs, fast decision-making, and more efficient capital allocation. Now, here's where it gets interesting and spicy. The institutions investing most aggressively in digital assets are often investing just as aggressively in artificial intelligence. This isn't a coincidence. Many executives increasingly view these technologies as complementary rather than competing. See, blockchain digitizes ownership. Artificial intelligence helps manage that complexity that comes with it. Together, they could reshape how financial institutions operate over the next decade. Whenever institutional blockchain adoption becomes part of the conversation, a handful of digital asset networks are mentioned repeatedly. Among them are XRP, XLM, and HBAR. Each has pursued a strategy that emphasizes enterprise or institutional use case rather than consumption, speculation alone, and consumer speculation. Supporters of XRP point to its focus on cross-border payments and settlement solutions. Supporters of XLM highlight its emphasis on efficient value transfer and financial inclusion. Supporters of HBAR often point to its enterprise governance model and regulation and relationships with major organizations. These characteristics have led some investors to believe they could benefit if tokenized financial infrastructure continues to expand. However, it's important to separate confirmed developments from expectations. No institution has publicly declared that one specific blockchain network will become the universal standard for tokenized finance. The industry remains highly competitive. Banks may adopt multiple technologies simultaneously. Private blockchains, public blockchains, and hybrid systems may all coexist. That uncertainty is important. Successful investing often involves understanding probabilities rather than certainties. What appears clear today is that institutional interest in blockchain infrastructure is growing. Which networks ultimately capture the greatest share of that opportunity remains an open question. A common question follows naturally, ladies and gentlemen, all of this. If institutions are investing so heavily Why haven't digital asset prices already exploded higher? The answer may lie less in blockchain technology and more in the broader macroeconomic environment. Over the past several years, central banks around the world have raised interest rates to combat inflation. Higher interest rates generally reduce liquidity throughout financial markets. Borrowing becomes more expensive. Investors become more selective. Risk appetite often declines. Historically, cryptocurrencies have been highly sensitive to liquidity conditions. That doesn't necessarily mean long-term adoption has stopped. No, it means that macroeconomic forces can overshadow structural developments for extended periods. Think about previous technology cycles. There have been many periods where infrastructure continued advancing, even while market prices struggled. Businesses kept investing, engineers kept building, products kept improving. Markets simply need time for economic conditions to align with those developments. This is why many long-term investors pay attention to both technology and macroeconomics. One explains where innovation may be heading. The other explains why markets move when they do. Prices react and systems evolving. I always tell you, ladies and gentlemen, you got to pay attention to what's quiet, even though it's like watching paint dry on the wall. History offers another useful perspective. During the late 1980s and early 1990s, much of the infrastructure that would eventually support the modern internet was already under construction. Fiber optic networks expanded, data centers grew, network standards improved. Most people barely noticed. The technology existed long before it became part of everyday life. When adoption accelerated years later, entirely new industries emerged. Online commerce transformed retail. Digital communications reshaped business. Cloud computing changed software. The companies that ultimately succeeded were not always the ones investors initially expected, but the infrastructure itself permanently changed the global economy. Blockchain may follow a similar path. Not every project will succeed. Not every prediction will prove correct. But if tokenization continues expanding, the underlying infrastructure could become increasingly important, regardless of which individual companies or networks ultimately lead the market. I want you to imagine standing at the site of a future skyscraper. For months, all you see are construction crews digging deep into the ground. Concrete trucks arrive. Steel beams disappear below the surface. There are no impressive views, no towering structure from the outside. It might even appear that very little progress is being made. Yet engineers understand that the foundation determines everything that follows. Only after the invisible work is complete can the building begin rising rapidly. Today's institutional blockchain initiatives resembles that foundation. Banks are investing in infrastructure. Regulators are developing frameworks. Technology companies are improving scalability. Asset managers are experimenting with tokenized products. Much of this work happens quietly away from the daily headlines. Whether adoption accelerates quickly or gradually, these foundational developments could reshape the financial system for years to come. Ladies and gentlemen, rather than focusing exclusively on short-term price movements, investors may find it more useful to monitor several structural trends. Watch for additional regulatory clarity surrounding digital assets. Pay attention to the launch of new tokenized investment products. Observe how stablecoins continue evolving within payment systems. Monitor institutional announcements involving digital collateral and blockchain settlement. Watch how central bank, commercial banks, and major asset managers continue experimenting with distributed ledger technology. These developments provide insight into the direction of the financial system itself. Markets often move ahead of public awareness. By the time transformational technologies become obvious to everyone, much of the foundational work has already been completed. That doesn't guarantee any particular investment outcome, but it does highlight why infrastructure stories often deserve close attention. Bank of America's decision to strengthen its digital asset leadership is more than a personal announcement. It reflects a broader institutional trend that has been developing for years. Across banking, asset management, and financial infrastructure, organizations are exploring how blockchain technology, tokenization, artificial intelligence, and digital collateral might improve the efficiency of global markets. There are still important questions. How quickly will regulation evolve? Which technologies will become industry standards? Which companies and blockchain networks will capture the greatest value? No one can answer those questions with certainty, but the direction of travel appears significantly increasingly. The conversation is no longer simply about cryptocurrency prices. It's about the modernization of financial infrastructure. History reminds us that the transformative changes rarely happen overnight. They unfold throughout years of investment, experimentation, and gradual adoption before reaching a tipping point. When the tokenization ultimately reaches trillions of dollars and assets or expands even further, the institutions building today are positioning themselves for that possibility. And that may be the biggest story investors should be watching. If you've enjoyed this deep dive into macroeconomics, institutional finance, and digital assets, be sure to subscribe to the channel. Leave a comment with your perspective on the future of tokenization. Share this video with anyone interested in where global finance may be heading, ladies and gentlemen. Thank you for watching, and I'll see you in the next video. Hope everyone's having a blessed Sunday, ladies and gentlemen. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Something I want you to pay attention to, that we're paying attention to, is the overall inflation story. We don't think the Fed will raise interest rates. If inflation is higher because energy is higher right now, that's momentary. That trickles into the overall view about metals moving higher, cryptos moving higher. We're in the camp that metals may put a short-term bottom in and move higher, so we like that. If you want to hear more about this, come and join the Crypto Public Desk Monthly. Inside there, one solid tip from the pits can pay for your entire year's subscription. This is not financial advice, ladies and gentlemen, my own perspective. Always consult a licensed financial advisor before making any investment decisions. Never invest any money based on watching a YouTube video. I love you all. I'm going to see you on the front lines. Again, watch the play between inflation, energy cost inflation. But we look, in our opinion, a short-term bottom could be putting in there with the overall view of higher interest rates, because that's driving everybody. But also at this point in time in the summer, most people are totally on vacation and they're not coming back to play until after Labor Day. I love you all. I'm going to see you on the front lines. Don't get caught up like sushi. Don't FOMO this. Gucci conviction, Gucci clarity. Why I say we're walking up this frosty mountain with our frosty beverage, because the top is a very frosty place to get to. I'll see you all on the front lines. I love you all.